Hello everyone, welcome to Paradigm Life's first client summit. I'm extremely humbled and excited to be someone presenting today. I hope you find great value in my presentation. I absolutely know you're going to find value in some of these other 20 or so topics that the agents are providing over the next couple of days that spread the full gamut of what we do and how we help clients on different aspects of life, business, and just finances in general. I'm excited to see what my peers create and watching them, quite honestly. I think you're going to find, as I said, value across the board here. So let's get started. I'm going to talk about real estate, the advantages of using that as an investment and an income source, the perpetual wealth system, specifically wealth maximization accounts, which is what we call high cash value life insurance. You may have heard it as infinite banking. But the combination of income producing real estate and wealth maximization accounts is powerful. The synergy that you hear talk about when you combine two things together really is true here. Wealth maximization accounts fill in holes where you have bumps in the road every once in a while with real estate, like maintaining adequate reserves, but maintaining those reserves in a place where they grow and tax-free and are protected in private. Like not having your down payment sitting there as dead equity in a property for years and years. Instead, keep it working, keep it available, have it do more than one job. That velocity of money is what, one of the cornerstones to wealth. So I'll talk about those two, but I'm also going to talk about it from the lens of my past experience, and I think I can add value to some other people that are in my situation, specifically the military. I spent 25 years as a naval officer on submarines, and regardless of where you are in the military, your life comes with some unknowns, with a schedule that continuously changes, with long deployments away from home, and a lot of time at work, not paying a lot of attention on your personal finances. Same thing could be said for entrepreneurs. I've been on that road now for about 5 years, and it's pretty similar. If you're bootstrapping a new young company, the income stream is anything but consistent. Perhaps you're producing products and you have to go retool the thing because it broke, or you got to go refund a bunch of them, or something happens on the delivery platform that you have and you can't get the product out there, or your customers don't pay on time. So there's a lot of things that create inconsistencies, unknowns in both of those worlds, and I thought I'd combine talk about the two of them and how perhaps real estate and wealth maximization accounts could help fill some of that void. So let's go. So my goal is to help you see things from a little bit different perspective, hopefully a better perspective. Give you some tools to start questioning the stuff that you've been just hearing on all of the financial news networks. You hear your neighbors talk about, you hear it at the water cooler, you see it in the magazines, and you see it on television. I lived with that stuff. I was immersed with it and I believed it for a good 20 years. But I think when you think about things from this a little bit different perspective, you'll start to ask questions, and perhaps you can start drawing the arrow of success that I show here on this page. That's my goal for you. So what makes the perpetual wealth system different? Why is it okay to be the uncomfortable blue fish that is going in the opposite direction? It's about the guarantees, the confidence, and the certainty that you're going to reach that destination. You can see it coming. There's no surprises. And you're just consistently on this conservative growth path to where you want to head. It's very comforting. And for me, for my personality, it was awesome. It has been awesome. It provides you that protection, knowing that your income, your hard-earned income, your dollars, your wealth are not going to go away. They're going to be there. And that provides the confidence to go out and try other things, try different ventures, because you're not always at risk of losing the principal, losing what was going to be your retirement. You see, I believe that the perpetual wealth system, I have learned that the perpetual wealth system is just a better place to store, access, and grow your wealth. I tell people that perpetual wealth is this foundation that's underneath your, hopefully one day, skyscraper of wealth. And there's different aspects of your wealth. Of course, you're going to partition it out. You're going to use your wealth in business operations. You're going to grow it there. You're going to use your wealth in real estate and grow it there. You're also going to someday use it for retirement. You're going to use it for funding college, other major purchases in life. But in the military and as entrepreneurs, sometimes this isn't so clear cut or so cut and dry. For example, in the military, we have an awesome college education program called the 9/11 GI Bill. It's a grant, and we can get some tremendous benefits, including housing allowance while going to college. So does it make sense to stack a bunch of money into 529 plans for our children if this other option is out there? Knowing that the 529 plan comes under the chopping block every year in the presidential budget, or has the last four, with the proposal that they take away the tax-free benefits for individuals who are, what they call wealthy, which in my book is not very wealthy. But somebody has penned that as wealthy, and somebody has an initiative to try to take away and tax those individuals. Coming back on a promise for something that we considered truth back when we started these things a decade or so ago, if you're in my situation. I don't like that idea. I don't like the idea that if I don't use all the dollars in college, I get penalized for using them for anything else. So how about maybe putting the money in a wealth maximization account and growing it there? You can use it the same way for college, but use the 9/11 bill first as an example. And the thrift savings plan, our retirement, right? 401ks, which the thrift savings plan essentially is, have an advantage where sometimes the employer will match your funds. They will match your contributions to help towards your retirement. But in the military, at least today, they don't do that. They haven't throughout my time. And so a little bit of the luster is gone there, right? So I will talk later about how I believe you really need to, pay the taxes first. Think Roth, think wealth maximization account. And so at least go to the Roth version of it, which is available. But once you've done that, there's few advantages of Roth over wealth maximization. Essentially, you need to be tax-free, but be tax-free and flexible. Be tax-free where you can get access to the money to do whatever you want with it before you're age 59 and a half. Entrepreneurs, same thing, except that it's from the perspective of funding your business, of having adequate reserves, of developing a retirement plan. The military, if you stick around long enough, you do have a retirement plan. We'll talk about that. Entrepreneurs, you don't only have that available, right? You can set up your own. You can set up your own 401k. There's a lot better plans, a lot more flexible plans that you can use the money for both funding your business and for your retirement. And those are pretty powerful. So as I said, it's more efficient, and it's also the best of both worlds in my opinion. So down here at the bottom, I show kind of where the wealth maximization account fits. On the left-hand side over here, you have savings and checking accounts, and that's just pure safety. It's certainty. It's protected, at least up to an amount, and you can kind of count on the money being there. And the individual that I was working through with this was 35 years old, and he was saving aggressively. He had this plan to save for 10 years and then go off and do something else, finish with his W-2 job forever. And these numbers are big. You can take a zero off every number on this page, and it would still work exactly the same. So don't let the size scare you if this is not an appropriate size for your situation. So on the left, safe savings world. On the right, many individuals will come, and they've heard buy term and invest the difference, and they've heard the talk that, hey, you can get an average annual return of 11%, like it shows down here at the bottom. And so I went and took a look at the last 25 years in the S&P 500, and in fact, it has 11% average annual return. But what I think people don't appreciate, they don't feel the weight of, are the things that drag down on what you would think in your mind is a savings account making 11% a year. That's certainly not what happens with this average annual return. First thing is fees and then taxes. Those are both pretty substantial, and we'll talk about those in more detail. But the thing that we don't appreciate is that average annual return does not apply to what's happening in your bank account. And simply the reason is because of the impact of these negative returns. I won't get too much into that here, but the combined impact of the big three, this volatility or the negative returns, the fees, and the taxes, turn this 11.15% return into a dollar value in an account that's lower than is projected to be, very conservatively projected to be in this wealth maximization account or in this life insurance policy. And here's the kicker. You've had access to all the dollars right here. Just like in the savings account, you've had access to all the dollars, none of the access to the dollars here. If you haven't invested in whatever the mutual fund is, you can't use it to go buy real estate with, right? You can't use it as collateral to go do other things. Sure, there is a way to leverage your brokerage account, but in most cases, it's not with it fully invested. and it comes at a limit. It's not 100%, and it's fairly risky because if you lose the underlying asset, they call that due, right? They call they call the margin on your loan. So it's comforting to know that this ultra safe, tax-free vehicle is growing better than some of the best years of the stock market, and will do 2.5 times better than a comparable savings account. The thing that I didn't talk about on this page, this gentleman had starting off $2 million of insurance and going up to $5 million. So if his plan doesn't play out, if he gets 3 years into this and tragically dies, his family is not at the end of the rope. They're not without a solution, right? He's only built $100,000. He was going for a couple of million, but his life insurance pays out more than $2 million at that moment. And so you lock in certainty that this plan will play out when you set it in place. And there's no certainty here on the right. There's little certainty on the left, especially not the life insurance side of it, in case you pass away before completion. So this ensures completion. It gives you the safety, and it gives you the returns comparable to the things in the stock market. Hey, what makes real estate a better investment? I mentioned that we were going to talk about real estate. So for me, it's the fact that it's the proven path to wealth across the globe for generations after generations. Everyone in the room, everyone on this podcast, I think could think of a few people, several people probably, they know that are wealthy. Their friend had wealthy parents, wealthy people in their hometown. All of them had real estate and probably got there by leveraging that real estate, by having it and allowing it to grow. Buy real estate today and let it grow. Few of us know of anyone who got wealthy in the stock market unless they're managing it, unless they're a hedge fund manager and they're getting wealthy off of the fees and things, not off of not off of the growth of their own investment. So real estate is a tax advantaged way to safely leverage your money in a hard asset that keeps up with inflation and provides passive income. It gives you that opportunity after time or over time to step back from your W-2. You're not beholden to that W-2 job. If you keep working at the job, it's because you love it, right? And many people do that. I loved the military. I loved submarining. I didn't love the time away from my family, and so eventually that's what caused me to make my decision. But it would be nice to stay there because you want to do it, right? So this gives you the opportunity to back away, to go do things with your family, to go chase that dream that you've had. It's been said that real estate is an ideal investment, and I certainly agree. It's an acronym that we'll go through several of the pieces of in my example today, but it stands for income, deductions, equity, appreciation, and leverage. And again, we'll go through quite a few of those during our discussion. So I love this picture. I love seeing determination, a refusal to quit, whether it's on a person or on a mouse. I think if you look at this mouse, we don't know whether he's going to get the cheese today, but we're pretty certain he's going to get the cheese. It's kind of Don Quixote, the look on Don Quixote's face as he went after the windmill. So my message to you is that if you have the determination to make it through the webinar, I will give you some resources at the end that I think will allow you to keep going forward on this if you hear things today that make you want to further question or actually get started, take some steps to put up a wealth maximization account and real estate in place. So I have an ebook. I have a few longer videos that get more into the details of this stuff that I'll make available to you. And then just some other things that, ways in which you can take steps towards perpetual wealth system and real estate. So looking forward to it. Stay in there, hang in there, put your helmet on. Okay, so my story. As I mentioned, 25 years in the military. And life in the military, like many busy careers, certainly those of entrepreneurs, comes with long hours, and it comes with a dedication, maybe 6-7 days a week for weeks on end. Long times away from the family. If you're military, you probably deploy for months on end. And it's not like today's world you're completely disconnected in most cases, but sometimes you are. But you're also working weird hours, right? You might be up in the middle of the night, or you might be in a time zone away during the day, but Wall Street's asleep, right? So even if you know things are changing, you may not be able to do anything about it. My solution to all of that was to just hand over the keys to the kingdom. I turned over management and control of my finances to a complete stranger, And I did it because that's what everybody said to do. And I did it because I figured they probably cared. They're professionals, right? And I think to an extent they do care, but they don't have a lot of control themselves. And they don't have a lot of training. And sometimes they're younger than us and haven't gone through the ups and downs. So it wasn't a good idea in my case. And I don't know if it was in yours. You know, the people here on this roller coaster, they seem pretty excited, like they're having fun. I tell you, for my personality, it was not fun. I did not enjoy all of these bumps in the road. This is a picture of Quicken, which I'm somewhat embarrassed to say is my level of sophistication when it comes to tracking my finances. But yeah, it was all over the place in the first decade that Susan and I were married. So nuts, and I didn't enjoy the downhill rides. You know, here's a more broader index look at what's been going on. And if you piece this back into history, you'll see 6 or 7 more of these back into the early 1900s or more. They're all about the same height. They just kind of keep bouncing up and down like a mountain chain until you get to this one. And, you know, so this is the dot-com crash of 2000. Here is the mortgage crisis of 2008 and 9. Here is where we should have gotten our nice little reset, but we were unwilling to say that it was recession time again. And we started quite a bit of quantitative easing right here. And that quantitative easing is a chicken that has not come home to roost yet. And I fear, you know, what's going to happen when it does, but it's going to be another nice one that gets us reset back down here. And when I go and do that math, you know, that's in the 80s percent correction. So, you know, we've seen things that are getting a little bit bigger. I feel this one's going to be pretty nice. So I'm not a trained stock trader, and so I'm not giving you a date in which it's going to happen. But if you look back over the last 100 years, it is sobering and convincing that you know, cycles repeat, and this one's coming. So I'm not telling you to run from the market. I'm telling you to pay attention to the market and don't go into free fall like I'll tell you about my story. So here it is. Here's the free falls, right? I love this on a roller coaster. I absolutely hate it when it's my finances. And it destroys everything about my life when it's happening. I can't concentrate. I'm not paying attention at work. My mood goes down, and my interaction with my family. It's just not fun. That's just the way I am when it comes to finances, because I see that as kind of a primal protect the family. Most people are this way. Certainly most guys are this way. We see our role of, you know, providing for the family. And when this is happening, I didn't feel like I was providing for my family. I felt like I was failing my family. And I hated that. So I had to find a way out of it. What makes this worse is that, you know, back to my story, in this red shaded area, I was preparing for and then taking command and then deploying with my submarine, you know, out of communication for a few months at a time. So I can use that as an excuse, but I could have done better than I did, and I certainly could have set myself up not to be exposed to this. There are many other people like me, though, that are in similar difficult jobs. And then there are people who just were afraid to look at it. They didn't want to look at it, or they stared at it in horror as this incredible descent was happening here. So that was painful for many people. I think it brought back, you know, memories of stories we heard about the Great Depression. And I started paying attention out here at the end and realizing the huge mistake that I made over 20 plus years of riding this roller coaster and not really getting very far ahead beyond what I'd personally contributed. I think I forgot to mention that if you just go search the S&P 500 index at inflection points, you'll get the updated, version of this, and they'll keep tracking it for us. JP Morgan's investment group, after Dodd-Frank, they now are not just a bank, but they'll very nicely track this for you, and you can go get updates and kind of watch it play out. So as I was starting to pay attention here in 2011, I started experiencing the first one. I saw the roller coaster going over, and I said, enough. I got my patriotic parachute, and I jumped off the roller coaster. And where did I go? Well, you know already. I mean, I went to real estate, and I chose that, but it doesn't have to be real estate. It has to be something where you've got some control. I went to real estate because I loved playing the game Monopoly since I was a little kid. And I loved Rich Dad, Poor Dad. I loved the idea of being able to improve properties. I just like being involved in it. And so I started, I took my money out of the stock market. I merged it with a wealth maximization account, and I started funding my properties from there. And I did it in the Midwest, across the U.S., using turnkey providers. That's a concept of, having kind of the full package come together, meaning that you can find a rehabbed property, the property manager, the maintenance team, the legal team, if you want to do that as well, all together in one package. Really, for the busy entrepreneur, for the busy military member, pretty decent solution, really. I found it to be pretty effective, and I did it for 5 years in the military. But I am quite literally hoping that I can do what the banker here did and turn little greenhouses into red hotels one day. So here's more of my Quicken, the later years of the story, and more roller coasters as I was going through the military there. And then in 2011, I put in this combination of perpetual wealth strategy and real estate. And you can see the impact. I mean, it is night and day, the impact on my family's wealth. And I literally at times feel like I'm on this airplane going upwards and to a certain destination, to some place that I can count on and at the pace that I can count on. It's been really wonderful for me and for the family. And quite literally every month this thing moves up a little bit or a lot. People will come to me and say, hey, Gary, the market, I don't want to bust your bubble, buddy, but the market has gone up during that period of time. And similar to like that, that funny commercial about the monkeys that are throwing darts, at the stock page and picking stocks and doing wonderfully. You could have done that, buddy. Maybe, but I'm not in the stock market. I'm not exposed to that. It really doesn't have any impact or any effect. The fact that it, by the way, has been going up during this period of time. That's true, but I don't think it's tied to what I'm doing. I'm not exposed to that. And really the economy hasn't improved that much right during this period. So this isn't just a reflection of the economy improving. It's a reflection of not ever going backwards. The market has been going up, but look at all of the gut check roller coaster rides that have happened in this same period of time. It's just over and over and over again. And this one didn't catch, the post-election fun that we had there for a day or two. So, I'm not into that anymore. I'm into not having to worry about the finances and spending time with family and getting good night's sleep. That's what I like. So how did I do it? I took all of this stuff that was in yellow, which was the investing portion, and over time, as I could make it happen, I converted it, to this bluish green section, which is property and debt, meaning that I purchased rental real estate properties with it. And I've been able to build about $3,000 a month of passive income over these 5 or so years that I've been doing it. It took a little bit of investment capital. It took some sweat equity and some learning, and I'll kind of give you some of those lessons as I go through that. Fantastic, phenomenal change for me. Okay, so I did do some things right, but I've done a ton of things wrong. The first thing I did was the first 20 years of just handing off everything to somebody else. But in these last 5 years, I've made quite a few mistakes as well, and hopefully you won't make them after I kind of talk about a few of them. You'll see a common theme here, and that's no control. One of the first things I did is I learned about this government contract lending job or investment opportunity. And I researched it and had a couple really good years, brand new company. They were about to explode. I think you've probably heard this story before. And as soon as I put my money in, it was a couple of months of beauty. And then the Ponzi scheme fell apart, and it quite literally was one. And I had a 100% loss. Thankfully, it was not a substantial amount of all of our money. But that was painful. And the thing is, I had no visibility, and I didn't know what was happening. But if I did, I couldn't control it anyway because I didn't have a controlling interest in anything. Similarly, I invested in an oil drilling partnership, put quite a bit of money in this, and I'm still involved in this one. It's basically at a dead stop. It looked really good while oil was $110 a barrel. Oil is now at 30-something, right? And so a few years later, it's just been kind of treading water. Thankfully, I haven't lost my money. But I, again, don't have the ability to get out. Right now, I would make the decision that we're in a long-term, a year ago I would have made that decision. We're in a long-term recovery for oil. I don't need to waste my time with my money sitting here. But I can't get out of this one, right? So again, no control because I'm just a small investor. I can't pick up the phone and sell it to somebody. I invested similarly in a syndicated medical office building project. Syndication just meaning that somebody else raised the money. I was a kind of silent partner investor in it. Without really too many voting rights. And it worked fine. It was a great opportunity. I did this one after some lessons learned with previous investments that I wanted to make sure that I knew the people well. So I invested with people that I trusted, knew, and they are good people, and they have stayed true to their word. The problem is that the environment changed. The equation changed. After Obamacare came out, a lot of the providers just weren't willing to expand their business like they had intended before. We were going to expand the size of the building, get a projected 15 to 20% return or better, and sell the property for a nice profit. Right now we have a 3% return. We've had that since the beginning. It's consistent, not the end of the world. I haven't lost money. I asked to be let out of the deal a year plus ago. There's no market for it. So again, no control, no ability to actually make a decision. With any amount of rental properties right now, I could pick up the phone and sell them if it's not the right time anymore to be in that market or in that property. So again, control, right, on those three. I had a couple others where I did have control and made some mistakes, and some of them are about my own personality. So I bought the first fourplex in a new construction neighborhood down south. Great neighborhood. The area is growing nicely. But it was unfortunately purchased through a builder that was running into problems. He had no integrity. He started taking money from one person to pay off another to keep them quiet. It all came falling down. There were lots of lawsuits from the subcontracting construction team in the city. Quite a mess. Through some substantial efforts by myself and the other owners, we got the properties up and running. The subdivision's performing, and they're starting to build there again finally. But it was rocky, and it was expensive. I had a real estate broker that I didn't know that well, but I learned in bad times people change, and this guy just ran ahead under a rock. It was very kind of disheartening. So from that I learned, make sure you know people well enough and have been around them long enough before you give them a substantial amount of money. And then I bought, finally my other story is that I've bought some C and D class properties, meaning properties that are in questionable areas with HUD Section 8 type tenants, and sometimes that's good in certain cities, but you got to be really, really smart about where you do it. I've made some mistakes. It hasn't been horrible, but I wouldn't make those decisions again, so I'm going to call it a mistake. It's just that one's more about your personality. What is it? What will you tolerate? What will you put up with? How much time do you want to commit to it? Wasn't a good fit for me. So I could tell you much more about that story. So listen, in the past 25 years, but certainly the last 5, traveling down this specific path I'm talking about, I've learned some things and I've made some mistakes, and I hope to be able to pass those to you so that you don't have to go repeat them for me. A wise person is someone who can learn from somebody else's mistakes before making them. So 3 secrets. I think there's 3 key things that I want to talk to you about that I can pass forward and add value. First secret is you must maintain control, and we've talked about that, I think, in at length already. The second one is that you must limit the impact of taxes, fees, and uncertainty. I call those the big 3. If you can somehow limit those or get rid of those, you are on an exceptional path to wealth. And we'll talk about those. But when I talk about uncertainty, I'm talking about market uncertainty or the uncertainty about the individual that you just got yourself hitched up to with a business. Are they going to turn around and steal everything from you? And then the third secret is that you must protect yourself against a short life and a long life. Now, protecting yourself against a long life, you're probably like, this guy's off his rocker. But what I'm talking about is protecting yourself from running out of money if you happen to be fortunate enough to have a long life. Listen, my goal is to live to 120 years old, and I'm going to do it surrounded by all my loved ones and family members if I do it right. And we're going to enjoy each other's company every day of it. But that doesn't happen if you're planning financially to make it to 85 and you find yourself at 100 or 120. You're gonna live a fairly impoverished life. It brings me back to that story, that funny movie Grumpy Old Men, right? And the one guy is wearing sweaters because he can't turn the heat on, and he's drinking his lunch is like chicken soup or something like that. No, it's tomato soup, because he just does not have any money left. So fixed income's okay if it's a nice big pension. Fixed income is not okay if it's Social Security and that's all you have. So we want to avoid that. Secret number 1, maintaining control. It's tough for military and entrepreneurs. It's really, really hard. But I think you can do it. I think I was pretty close to doing it, and I think I could have maintained my life in the military doing it. It comes, with real estate, it comes by having your stuff managed by these, it doesn't have to be turnkey, but finding competent, ethical individuals to manage your properties for you. For your business, it comes by finding one that you can have run without you being there, right? So maybe it's a Five Guys franchise, or maybe it's a coin laundry facility. Maybe it's an online business that you built up to the point where it can be managed by people you've employed and still provide income for you. Royalties from intellectual property is another great idea. You can either create this equity this value by making the book or the movie or the video, or you can actually purchase royalties and purchase the ability to get the future stream of income, which is pretty fantastic in some cases. I talk about a little bit in my ebook, and we have some other resources at Paradigm Life. But specifically about the real estate, I will get into that and provide a specific example here in just a moment. But first, secret 2, limiting the impact of the big 3: taxes, fees, and uncertainty. Listen, when it comes to taxes are going up in America. I mean, I think we just have to, kind of become okay with that. Look at this chart. If you look here in World War II, Vietnam era, that's a time where in America we had not yet divorced ourselves from the gold standard, and we were taxing people to the level that basically covered our expenses. Our national debt would go up every once in a while to fund wars, basically, but it was not out of control. Here in the 70s, we learned how to print money, and you can see what's happened to the tax rate. We have just, sort of stopped taxing people, but we print money, which causes inflation, which is the silent tax. It's the same thing, but we're at about the point where we've got to stop doing a lot of this quantitative easing and money printing, or the currency is going to fall apart. So in my humble opinion, non-formal economist opinion, one of 2 things has to happen. We have to back off on the printing and actually start taxing people to normal levels to get the income that we need to run the government, and we got to squeeze down on the size of that government. But in the meantime, we still have to raise the income source, and I don't think it can come from continued printing. The other thing is that maybe a reset occurs and we go back to, kind of reset everything and start with a new tax system. It's going to be something that's higher than it currently is. This blue line here I put on is the flat 15% tax, which has been shown by many economists to be really, really smart idea and probably the most effective. But that's even higher than what we currently have. So I think, going back, getting off my soapbox on taxes, I think taxes in America are going to go up. And it's not going to be a long time from now, personally. I think your goal ought to also be for 2017 and beyond is to raise your personal tax bracket with respect to people around you. And I just mean by that it makes you successful, right? If Robert Helms of Real Estate Guys does this kind of famous thing every once in a while where he asks, hey, who out there in the audience wants to pay more taxes? Of course, no one raises their hand except for the people who have been through his presentation before. And all of us are raising our hands as high as we can because it means that we're making more money. And I'm good with that. If the reason that I want to pay as little as I possibly can, as I legally can, but I'm okay with paying more if it's because I'm making more money. So I recommend you make that your goal as well. So my takeaway is pay the taxes now. Don't get in a situation where you're doing this tax deferred thing, whether it be 401k or IRA, because your future taxes are going to be higher, and you also have lost access to all those dollars. The thing that comes with, the ball and chain that comes with that commitment or that agreement to get a tax break today, you lose access to that money really for a majority until you get to 59.5, unless you want to pay a lot of fees. So my recommendation: permanently tax free. Pay the taxes, get it into a permanent tax free vehicle, and keep it there. I learned a lot in reading John D. Rockefeller's biography, and I highly recommend that you read this one. It talks a lot about his life and how he made his money in oil, and that's fascinating. But what I really am talking about now, and what I thought was really interesting, were the later chapters of the book where it talked about his children and his grandchildren and great-grandchildren, and how they have maintained the family legacy, the family wealth, through the Rockefeller Foundation. And they do it by a combination of educating all the young ones on financial management before they get any access to the money. But they also do it by growing and operating the thing tax-free. And they give away millions of dollars every year to charities and other causes that they think are important. But they continue to perpetuate the foundation. But go look at the Carnegies, go look at the Vanderbilts, other wealthy families, in the Roaring 20s. Their money's not around because they didn't get locked in that tax-free growth. Now, of course, the Rockefellers achieved this by getting this foundation put in place before the U.S. Constitution was changed to allow taxation or put in place the 1913 taxation. But you can do it with your family. I mean, imagine you and I, the trailblazers, we start wealth maximization accounts, permanent tax-free growth of our money with after-tax dollars. So we're paying taxes on our dollars. But it gets in there and it grows tax-free. We access it tax-free throughout our lives to fund businesses. We increase the size of the wealth maximization account by income coming from the businesses and real estate. And we use it throughout our retirement, and then we pass it on tax-free to our children. By this point, they've learned how to manage their finances. They put it into a tax-free vehicle. It grows tax-free for their grandchildren and great-grandchildren. And so you've kind of got your own little Rockefeller Foundation going, a stable family wealth. And that really inspires me to think about that perhaps Paradigm and all of you are able to start putting that stuff into place. Hey, listen, those for military, there are challenges and opportunities, and same thing for the entrepreneurs. The Chinese say that challenge and opportunity are the same thing. In every challenge becomes an opportunity, and I really agree with that. And I think the opportunity is for the military to use, and for the entrepreneurs to use their very unstable cash flows, things that I've listed here, to fund a wealth maximization account, and use that opportunity to start growing some true tax-free wealth. Things like tax-free income that comes for the military. And if you get that stuff, put that somewhere where it's permanently tax-free. You didn't have to pay taxes on it. You never will. So grow it tax-free. That's fantastic. Advanced pay that comes, big lumps of sum that come with bonuses or in preparation for moving. And then the mountain of expenses that come with that move that we do every year to 3 years. And by the way, it gets more frequent the more senior you get. So having a vehicle, a bank that's very flexible but also grows that money tax-free, just fantastic stuff. Entrepreneurs, same thing, right? We're bootstrapping companies. We're really have inconsistent cash flows. Sometimes we don't have the ability to go get credit because our business hasn't proven itself. So having that source that you can depend on and that will grow those big substantial reserves that you need to keep around is helpful. So that's the tax side, right? Fees. I'm confident that very few, 1 in 100 Americans actually appreciate the impact that their fees are having on their finances. Here's a quick example. So here's a 40-year-old. There's a person who grows $10,000 over 40 years at 6% in this magical savings account that's not taxed and has no fees. It would be $103,000 after those 40 years. I mean, compounding interest is pretty impressive. But there are fees, right? And the question is, well, how big are those fees? And, I think most people, if asked, would say, hey, my Vanguard fund has a 0.5 index. It's an index fund. It has a 0.5 expense ratio. Or, hey, my thrift savings plan has 0.3 on one of them and it has 0.7 on the other one. I feel pretty good. And I thought that was it. I thought that was what was really coming out. All of the money made minus that 0.3% was what I made. But that's not even close. Recent financial publication studies have indicated that the range ought to be somewhere between 2.5% and 6.5%, pushing on the higher side when you're talking about 401ks and other retirement plans. And the reason is because all of these things layer, and I did not appreciate that. That 0.7 that's there for my thrift savings plan is on top of whatever fees are there for the mutual fund management fees and all of the other trading fees and things that are there as well. It's not just the 0.7. And when you talk about the 0.5 at Vanguard versus the 1.5 at Fidelity, you're talking about management or advisory fees. And that's the part that has to be reported. There was this thing where I forgot the name of it, but it's the advertisement fee, the something B fee. Anyway, it wasn't being reported and it was a big deal to everyone, but that's still peanuts, right? There's so much more out there that we're just not required to be reported. And quite honestly, the mutual fund industry has trouble even quantifying what those costs are. But there are things like expense ratios and sales loads, brokerage account fees, trade commissions. So, each section here, each one of these titles has a big breakout of all of the fees that was in this U.S. News and World Report article. And I'll send you the link to it if you'd like. But let's just look at the brokerage account fees. I mean, there's a substantial number of those. And so this stuff adds up, and I think it's why they have trouble quantifying it. But again, the estimates from the financial industry is 2.5 to 6.5. So I put 2.5% on this. And again, as I said, I think people maybe can appreciate that 2.5% is a substantial part of this 6%. But I don't think many people would say that this $103,000 turns into $37,000. I mean, that seems criminal, right? And the reason that it's such a big impact, the reason that more than 2/3 of the money's gone, is because it does two things, really. It is a substantial amount of the money being taken away and given to the managers, but it's also preventing future growth of those dollars, right? The compounding interest of it. So there's a inability to grow and an actual physical taking away, and those two combined have a substantial impact. You see, it's 2.5% on the whole account value. It's not 2.5% of what you contribute that year, right? So when your account gets big in your retirement, there's thousands and thousands of dollars that are going to other people, and I think you need to minimize or stop that if your intent is to get wealthy. And in fact, if you were in the highest possible tax bracket, you still would not lose as much money as you lose due to that small 2.5% fee alone. So again, I don't think people appreciate that. I think it's just a pretty sobering realization. I hope that it kind of opens some eyes out there if you're in that group that really has not thought about that. Uncertainty, right? The volatility of the ability to lose the principal, lose your money that's inside your account can be substantial as well, and it's probably more impacting than the fees. So I kind of saved the best for last, I guess. So one thing to understand is that losses require twice as big of a gain to get back to where you started. Now, I'm not trying to give a math lesson here. I'm not trying to show you how smart I am. I'm trying to point out that the annual return, the average annual return that is the benchmark there in the financial industry, does not really talk about what happens in your account. It does if there was always positive returns, but anytime that a negative return gets factored in there, it's not accurate. And that's why I wanted to show this example. So if you had $2 and you have a 50% loss, you lose half of it, of course you're at $1, right? But to get back to where you started, to get back to $2, you need a 100% gain to get back there. And by the way, the average annual return on this little example is 25%. And I won't go through that example here, but if you have a 25% gain and you're just back where you started, which is zero in my book, something's wrong, right? And I get into that in detail in my ebook. So let's look at a case where a person's using this account in their retirement. So they start off with $1 million that they've grown over 30 years, and then they want to. They think that they're going to get 14.84% in retirement. Now that's higher than most of us would assume we would get, but let's just say they did get that. And this is a magical account with no taxes and no other fees, and there's no chance that you can lose principal, so there's no negative returns. They're going to pull off $100,000 a year for 30 years, and no problems. They're at $15 million and skyrocketing up. It's time to increase their spending budget, right? But if you get to the real world where this money's invested in the general stock market, and that 14.84% comes with negatives periodically, which we just looked at, JP Morgan's chart, right? Well, this negative 26%, for example, using this rule up here, needs a positive 57 somewhere, or 55%. And you don't see that down here, right? It doesn't come. So this is a typical result that comes with volatility in the market. That's something that if you could get consistent returns, which you can get in a wealth maximization account, if you could get that over here, you'd be okay. But in this case, they're completely broke in 13 years. And that ought to be sobering for you. That's something that's going to 15 million is completely broke with the same average annual return. It ought to give you confidence that the benchmark average annual return is not the full story. And it can get us in trouble by believing it's the full story. Third secret, got to protect ourselves over a lifetime, right? Got to protect from an unexpectedly short life, protect our family from that, and protect ourselves from an unexpectedly long life that we haven't planned for and we can't afford. So short life, that's pretty straightforward. That's life insurance, right? And, for many people, the first step is term insurance. And for the military, there's a tremendous asset that we have called Service Members Group Life Insurance. And I can remember sometimes myself thinking, why am I paying for this? And I can certainly remember some vocal members of my friends who are saying, I'm not paying for it. And you don't have to. You can not pay for it if you want. But it is substantially credited by the government. They are supplementing it. And so what you pay for that SGLI is ridiculously small, including what you're paying for your family members. So my advice to you, keep that. No matter how much insurance you have on your own, keep that stuff. it's a deal you'll never get anywhere else. And I kept mine until the moment they took it away. Now, VA or Veterans Group Life Insurance is a different story. That's insurance that you get only if you can't afford something else because maybe you were you became too ill or hurt while in the military. So you need your own solution after you get out of the military if you're retiring. But for the entrepreneur and for the individuals who leave the military earlier, at some point you got to transition out of that first step of term insurance into something that's permanent. Otherwise, you end up not having insurance later in life. And yes, there are those out there that preach the idea of self-insuring as you get older. The kids are out of the home, the house is paid off, and self-insuring, right? But I ask those individuals, does that really make sense to you? I mean, the best asset that you have, your own ability to earn money, is by far the biggest asset that any of us have. We certainly wouldn't, the day our house gets paid off, the day that all of our money is in this thing now, we stop our home insurance. The day we pay our car off, we don't just stop the insurance on the car, right? But we do that with our lives once we're at retirement or once our kids are out of the home or something. It doesn't make sense. And you want to just transition from term into permanent as soon as you can because your wealth is there, you're growing your wealth, there's all those other advantages, but you're also starting to recapture the cost of insurance. You get the insurance coming along for the ride with the bank that you've set in place. It's substantial. And it also provides you opportunities for long life protection down the road. And what do I mean by that? Well, hey, long life protection is a pension, and it's what it's what companies used to give us. If you're retired military like myself, the government gives you one, and it's pretty awesome. But there still are questions about there are questions about things you still need to put in place. Like, for example, do you carry what's called service members, the spouse benefit, SBP, spousal benefit program. And what that means is that you can give up a portion of your income today while you're alive, every month you're alive, to allow your spouse to continue on with the pension when you pass away. You can only get up to 55% of what you currently have. But maybe that's not enough for you. Maybe you want more guaranteed income down the road, and then maybe you want to set up a private pension for that. If you're not retiring and you're an entrepreneur, and you don't have some company that you're getting the W-2 from that's providing you that income, well, you got to set up your own. And protection from running out of money in a long life, having guaranteed income for the rest of your life, is what life insurance companies have always been since the 1800s the number one premier experts at doing. There's different ways to do these pensions or do these annuities, and we can talk to you about all the different ways. In fact, some of the other members, the other agents, are doing presentations on that here. But bottom line is you need an amount of your money to be a guaranteed income. Patrick talks about this seesaw where you balance the unpredictability of your 401k, your lump sum assets that are exposed to the market, balance that with something that is a guaranteed income source, something that that has statistics of people's age and life expectancy tied to it. It's a vehicle that's worked again for 150 years, and you need some portion of it in your life. You really do, and that's what protects you for a happy long life. So let's get into this real estate thing. So this is how I do my real estate. I use a conventional bank loan and lock in 30-year fixed interest rates for as long as I can and as many as I can, and I get 20 to 25% down. And then instead of having my money sitting in there, so to get a little bit more asset protection, instead of having my down payment money there, and also to keep my money moving, as we talked about the velocity of money creating wealth, I go to the insurance company and ask them to, instead of me, have them fund the down payment and give me what's called an unstructured loan, which means there's no qualification requirements and there's really no repayment requirements. And we teach clients how to best pay that back strategically. But in the end, there's really no requirement from the insurance company. You're not on the hook. You're not going to get foreclosed on. Because fundamentally what you're doing is you're taking a portion of your money up here and you are pledging it as collateral for the loan from the insurance company. I mean, that's fundamentally a wealth maximization account. It doesn't have to be for real estate. It can be for anything. But that's really how the process works. And your money is up there doing numerous jobs now, earning still its interest and dividends, still providing the insurance, and now serving as collateral as well. But that's not what I'm going to talk about in this simple example. It is what I have for you as a kind of add-on video later on. It's about 20 minutes long, and it will dive into a calculator that helps you see the combination of these two loans working together and how it benefits even further from this simple example I'm going to talk about. So this is just, if you imagine two houses side by side on a suburban street in America, and they're $100,000 houses. We're going to assume a 3% appreciation in the area and income, net operating income, which just means income after all expenses, of $500 a month. And we're going to hold these properties for 30 years, and we're going to see how it plays out. For the first one, we've got a cash buyer over here, and this guy just does not believe in leverage. He doesn't believe in being in debt. He's going to take his $100,000 and put it into that property and leave it in that property for 30 years. Now, lots of asset protection issues here, lots of stagnant, no velocity of his money, lots of issues, but that's the path he wants to take. He's most comfortable with it. So we talked earlier about the different aspects of real estate, and you've got the income coming from the tenant, you've got depreciation or other deductions. This one we're not going to talk about. You've also got equity building up, meaning that the tenant, when he helps you pay the mortgage down, is getting rid of that loan. The appreciation and the leverage. Of course, there's no equity building when your money's already there. You don't have a loan, so the tenant's not paying that down for you. So we'll talk about everything but the tax deductions, depreciation stuff as we go through this. But just understand that those are also not reflected here and are pretty substantial. So the cash buyer, he gets the appreciation over the 30 years, and his $100,000 house turns into $242,726 house if he had consistent 3%, which is really, really low. It's more like probably 5 nationally. He also gets the income for those 360 months for another $180,000. And then when you back out your investment, the original dollars, he has a growth, he has a return, $322,726. Not bad. It's not huge for a 30-year period of time, but you get wealthy if you have a few of those. And understand that there's those other deductions that we haven't talked about, those tax benefits. So now if we move over and instead of putting our money into the property, instead we simply just redirect it and leave it in the wealth maximization account and call the insurance company and say, please, fund the money, the full $100,000 in there for me. And so they do that. Well, you're still going to get the appreciation. The house value is still going to go up, and you get credit for that because you have control of the property. You also get all of this income that's coming in, so you get that $180,000. But the thing that's different is that you're paying down this loan now to the insurance company, and I assumed it was at 5% over those 30 years, and so you would have paid $193,256. So you take that out, and now all of a sudden we're only at $229,470, which looks worse than the $322,726. But now remember what's happening with our money, right? Our money has been sitting in that wealth maximization account, all protected and private and providing the insurance and growing, right? It's getting its interest and dividend unaffected by the fact that it was pledged as collateral. So when you add that back in, now that $100,000 at 4.5% grows to a profit of $274,532. You add that in, and now we have 1.5 times as much money. Do that numerous times over your life with several different properties, and you start to see the wealth generation that you've been seeing around you in those wealthy families we talked about. They've all got real estate, and it's helped them get that wealth. Okay, so that was my talk about real estate. Obviously, it goes much farther than that. As I said, the example that I show you in a moment, and I provide you a link to, goes much more into detail than that. So my action steps. I wrote a short ebook. It's 30 or 40 pages. Most of them are pictures. But it goes into detail into these topics and a little bit more about how we design wealth maximization accounts, how they might apply for business, and some other things that you'll see here at the summit. I think it's a good read. I hope you appreciate it. It will probably be available in my booth, but if not, please send me an email to gpinkerton@paradigmlife.net, and I'll send you a copy gladly. And then if you would like to take the next step and you're not a current client of mine or we haven't done meetings, and are interested about learning more about perpetual wealth strategy tied with real estate, then either send me an email again or go to this site or go to this address. It's my page at Paradigm Life, and there's a little box here, and you can sign up to talk, and we'll our team will set us up to have a discussion. I would love to do so. This is the video I was mentioning that gets deeper into the topic of using bank loans and loan against from the insurance company. It shows both of those. It shows me toggling one on and one off and showing the improvement in performance. It also gets into depreciation and the other tax deductions. I do this on a sample property from Memphis, Tennessee that's actually one of Jason Hartman's, very similar to a couple I've purchased. And I just kind of break down the nuts and bolts. And this is a really long Dropbox public link here, so just email me and I'll send you a copy of this thing. And by the way, these pro formas might be a little challenging, so another great recommendation I have for you is to go to Jason's website, or jasonhartman.com, or you can just go to this link right here, which is his YouTube channel. And he spends almost 30 minutes going over one of these pro formas. Really nice, slow, detailed analysis of what you should look at when you're considering a property or considering an area to purchase. So I think you'll find that very, very helpful. Here's my biggest recommendation and my last call to action. So if you I recommend you try to go to this Jason Hartman Meet the Masters event. It's a weekend in January 21 and 22. It's an annual event, typically holds it in Southern California. This one's in Irvine. It's not free, but it's really, really reduced in price right now. And hopefully it still is on the 8th and 9th, but if not, I'll figure out a way to help you get it at that rate. It's a 2-day action-packed event. I've been twice. I'm going again this year, and he brings individuals from industry. He brings individuals to talk about asset protection, taxation, just all the aspects that you'd want to put in place as a real estate investor. But the really powerful thing that I've found is that when you're trying to figure out, when you're shopping for an area, a place around the country to put your dollars, these people fly in, and there's typically 6 or 7 area providers, those turnkey providers that Jason works with around the country that come, and you get to spend lunch with them. You get to listen to their presentation. That we typically do panels like you see in the upper right here, and you get to ask all kinds of questions. I found that tremendously valuable in deciding where do I want to go look at properties. And I still recommend you go and walk around, put some boots on the ground, and see the areas and see the properties, see the individuals, see their operation. But this is a great place to get a huge head start. It's a full 2 days, but it's pretty awesome too. So I really recommend you look into that. And that's it, ladies and gentlemen. I hope you appreciated this. I hope you enjoyed it. I hope it added some value. There's some great other events here, and I really look forward to it. Please visit my booth. Send me an email. I'll send you all those resources. And good luck and happy investing. And I hope you have an awesome future. Thanks.